Good. Thank you for your attention. Once again, this is hosted and brought to you by Admiral Markets. All right, take a look. Find out more at admiralmarkets.com. And we're going to take a look at drawdowns. A lot of things we've discussed together in these webinars, from ranging from moving averages to strategies to risk management and trading psychology. But if there's one thing that in the end of the day really matters, it's like the basic primary thing that really is so difficult for traders to handle is drawdowns. If we don't have a mental grasp on this particular aspect, really all the other things are not so meaningful, because we could be the best really in almost everything, but if we get blocked down, if we get annoyed by drawdowns, if we can't handle the drawdowns, then despite all the other successes, it's not going to work. Now, the reason for that is because first of all, we encounter drawdowns frequently and sometimes deeply. Second of all, it's because it's so natural element of trading. We're going to encounter it first of all. Second of all, we are going to have, most traders have problems with it because of the psychological ideas connected to it, that the trading strategy is not working, we must be doing something wrong, where it's actually perfectly normal to have drawdowns. We cannot and never will have only wins. For instance, you always have losses, and when you have losses, you have streaks of losses, and when you have streaks of losses, you will have a drawdown. You can't avoid that. It's difficult mentally to handle, I guess, because of the fact that it just shakes our confidence in our approach and ourselves, and it's not easy to keep marching forward, keep going on the same path. Doesn't mean that we never should evaluate what's going on and why do we have a drawdown, what could be different, what could be the reasons. I mean, I don't want to discourage useful insights and good analysis, but we should be prepared for it and expect it. Basically, just like anything in trading, like price moves up and down, the trade goes against us, the trade goes with us. The equity curve does the same. It's the same movements up and down. We see it all across the board. This could be an example of a chart. It could be an example of your trade, and it could easily be an example of your equity curve. We really don't know what the green line could represent, because it could represent all three of those things. So in that regard, the market is universal in this way. So the equity curve is going to have a development. Of course, it is important that in the long term, of course, our equity curve is up. We should have some uptrend in the long term, of course, or medium term. Otherwise, why would we be taking that risk? Then we might as well invest maybe the money in something less risky, and we would maybe just get as much profit out of it, or not lose, let's say, right? There has to be some positive ring to it, otherwise why even go through the trouble? But before we get to that, let's say, medium long-term positive goal, there's going to be these ups and downs, and that is called drawdown. I think everyone should be aware of the concept. The drawdown is basically where we have, let's say our account goes up from 0 up to 10%, and then moves down to 4, and then continues up again. The high point here was 10. The low point was +4, which means we went down from equity peak to equity low here by 6%. That drawdown is 6% in that case, but it could also be in a negative territory. Let's say the account goes down from 0 to -10, then climbs up to 5, and then goes down to -20. Well, then the biggest drawdown here is 15. Why? Because here it went from 0 to 10, that's -10, and here it went from -5 to -20, that's -15. So the biggest drawdown is -15. We're always interested in the biggest drawdown because that gives an idea what kind of resistance we could face. All right. The long term, as I said, should be up. Let's see, and we're trying to distinguish the noise and signal to make a judgment on B. What is the real trend And when you see a trend, of course, it will go like this in reality, right? It will never be a smooth curve. So we have to realize that a lot of ups and downs are noise, but somewhere in that noise there is a kind of a signal, that a trend that we could see. So how to mentally prepare yourself for these drawdowns, that we are ready and are able to focus on preparing ourselves and handling it. So first of all, point B, we must expect the drawdown to occur. Just mentally expecting it is important, and realizing that it always will occur. I think that already would be a big improvement. I don't know how many of you really think about it that much, that we must expect it. Probably it's more something like, ooh, I hope it doesn't happen, or I hope it's not too bad, or I hope we kind of turn a blind eye to it. We try to not think about it. We try to avoid the topic. We just kind of like steer around it like it's this icky kind of puddle that we just don't want to even confront. Well, instead of kind of avoiding the topic, instead of not tackling it, it's better actually to think about it clearly and be ready for it mentally. It's a lot more value than just trying to avoid the whole idea of drawdown. Drawdown is going to happen, so we might as well be prepared and ready for it, and know that it will happen, and we must expect it. Be more forceful with your thought. Confront your own thoughts with it. Just forcing yourself to be exposed to it, to think about it, will remove kind of that yuckiness that it might have in your mind. And I don't know if that's true, but I think for some, surely that is the case. Now, what kind of drawdown should we expect, or must we expect? There are various numbers that are used, but often enough people hint to the fact that we should take our profit target. I think it is a good method. You take your profit target for the year, and you take 40 or 60% of that, and realize that that should be what you should expect. So let's say you're targeting 50% profit at the end of 2015. What would the minimum drawdown be that you should expect within that year? Well, we take the 50%, the profit target, and we multiply it by the 40 to 60%. So what is 40% of 50%? Well, that's 2/5, which is 20%. So I do that in red. So we should expect 20%, or 60 of 30 is 30%. So if we aim for 50% in a yearly, we must expect 20 to 30. Now, does that mean it will happen? Not necessarily. It doesn't have to. We could perfectly have a 10% or 50% drawdown that year. It doesn't have to be 20 to 30 necessarily, just as a standard rule. But it's something we must expect, and shouldn't be shocked by it if it happens. All right? 20 to 30. Is that a lot? Do you think, is that a lot for you, 20 to 30%? I think not. I think it's a level that most people will feel comfortable with, but few of you might still think it's too much. It would be interesting to see what is an ideal drawdown, an acceptable drawdown for most people. I think that more than 50, more than 40 is really getting into quite risky territory. I wouldn't think that many would be tolerant for that, because then you really have to go back pretty aggressively after that to climb back. I think that's a pretty steep order to handle. 20 to 30, I think, is quite moderate still for most, probably. But if that's not you, then of course you can try to reduce that. I mean, obviously, if you then target 100%, what would those numbers be? Well, logically, they're going to be twice as much, not 20 to 30, but they're going to be 40 to 60, right? So how about if you're aiming, what if you're aiming for 200%? What drawdown should you expect? 80 to 120. Now, have a drawdown of 120? No. Because, of course, when we hit the drawdown of 100%, we lose our entire capital. We lost the entire trading capital, 100%. So we can't, of course, lose more than, well, normally speaking, you wouldn't expect to lose more than that. So Obviously, if you're aiming for 200% a year, you must expect actually to lose the trading capital. Will you lose the trading capital? As I said, you never know. It doesn't have to be. But you're taking so much risk that the chance is there and you should expect it to happen. Others, actually, that's an aggressive formula. Others, a more conservative way of looking at it, is that they look at it as a 1-to-1 ratio. If you are aiming, therefore, at a 50% target, you should expect to have a drawdown of 50%. If you're aiming for 100%, you should expect to lose the trading capital. If you aim for 20, you should expect 20% drawdown. Now, I think that both are valid. It really depends how much experience you have. If you're starting out, if you're relatively new to trading, definitely go for the more conservative 100% 1-to-1 ratio. If you have already had, let's say, a year or two of profitability, maybe then you can become a bit more aggressive with what to expect in your drawdown, slowly but surely. Oh, here I have some examples. In fact, I didn't realize that I already prepared it. So, well, this is basically confirming what we already said, 25% per year, 50% per year, 100% per year. So you can see that anyone saying, yeah, this whatever is offered creates I don't know, 30% a month or 20% a month. This is great. Well, the claims, I don't know, could be half true, or I don't. It seems, of course, like a very lot, but it could be half true. But what is the flip side is that you probably lose your capital in the third month, right? Such tactics, very aggressive tactics, are not necessarily wrong, as long as you use that with a risk capital that you really don't mind at all losing. It must be a risk capital that you have no fear of losing whatsoever. It doesn't impact you a single bit. So whatever that amount is, it's different for every person. For John, it could be $10, and for Alex, it could be $10,000, and for Elena, it could be $100. Depending on your capital and your risk tolerance, that level will be different for everyone. Everyone has a certain level that they really don't care that they lose. If you're a millionaire, you're not going to care that you lose the dollar, right? Let's face it. That you can always risk. You can always take a capital like that and really risk high with that, because it really doesn't matter. But with normal capitals, you don't want to do that, of course. That levels of risk. And so if anyone is saying outrageous numbers, then you realize that there's always the fact that the drawdown will be so high that you're going to bump into losing the capital. Or you should expect it. But that, of course, is never said, that particular angle. So why expecting drawdown is important? Trading psychology, matching basically our the equity curve, the drawdown, the strategy, and our psychology together, so that we have a fit that suits us, so that we know what kind of risk capital and tolerance of risk we should have, and what kind of risk levels and risk management we should do. So it's one part is the risk itself. The other part, as you can see, is the psychology, so that we have everything well set up for ourselves, and we're ready for that. So let's dive into these things. Trading psychology. Well, any equity curve is going to have some problem. It's going to be some ways a bit tough, because the equity curve is going to have always some ups and downs. That itself is always tough, these ups and downs. Some equity curves are going to be, of course, a bit nicer than others. So you have to make sure that you are ready for your equity curve, whatever strategy and style you choose. It's very important because, not that I've asked many traders, why did you stop trading? But if I would have to make a bet, what is the number one reason? I would bet on the fact they couldn't handle drawdown. Is something that I think is definitely a reason. It's difficult to handle. Let's see. Equity curve must be something survivable. Must be something that we are able to trade. When you look at a back test of a strategy, and you back test it for 5 years, and you see the strategy eventually here start with 10,000, and it ends up with $500,000 or $1 million. What you see is something like this. Something like that usually. And you don't see the ups and downs in that path in those 5 years, right? Because it's this one smooth curve up. But that's very deceptive, because if you then look at periods of this curve, you will see a lot of the story. At the beginning, that 10K could have dropped all the way to 6K and then rebound. If you give up here, you would never have reached the target. Maybe when you went from 10K, eventually hit 100K, maybe you went all the way down to 40K before moving up. You wouldn't see that in the long term in 5 years. It all vanishes. That's why it's when you have a strategy that has, for instance, you test it and you see a positive figure, you see a good number, and you're happy and you think, wow, I just made an algorithm here that is going to give me great profit in the long run. What traders never think about is the day-to-day handling of that equity curve, because when you look at that strategy, how many winning days do you have? What were the roughest days, the biggest losing days? What were the biggest losing streaks? And can you really handle that from a day-to-day perspective? Because when you trade it really from day to day, then you have to wait to the next day before you have the next result. When you, of course, do a back test like that, boom, you have everything in one shot. But in real life, you have day 1, day 2. You really have to wait for day 2. You cannot see all of a sudden that, oh, it ended up well. So you have to have the patience to let every day play out. Every day. Every day. And not let these ups and downs wither your resolve and determination. When you see this in 5 years, it looks great. But after day 10, and you're down 3K and 30%, the mental curve here, the equity curve that you see here, isn't much of a consolation anymore. It might be still a bit, but every time things go against you, it's more difficult to stay on course, because you're living through the equity curve instead of seeing it in a grand scale. So that's why it's so important to mentally prepare yourself for it. And also be aware of the statistics. Be aware what is an average distribution of streaks and losses for your strategy. All right, matching drawdown strategy and psychology here. So as we've said in other webinars before, strategy and psychology are very important, because you want to trade something that you can handle. You want to trade something that suits you. That's why if you're learning a strategy that is very rigid in its character and its rules, it might not be for you. And it has nothing to do, it's not bad, it's not your fault. It's just that your way of looking at the market and that very rigid strategy are not in tune with each other. That same strategy could be very useful for another trader, but not for you. That's why when you're looking to trade strategies and you develop something your own, or you try to copy a strategy from someone else, especially in the second case, you want to find something that is flexible so that you have a way to mold it to your own personality. Now, if we take that a step further, besides strategy and psychology, the drawdown fits within this picture, because yes, strategy and psychology are good to match, but if the strategy creates a equity curve that looks like this, it's still not match you. So that's why the equity curve is like a third dimension. Important that this is all balanced. Alrighty. We also have to realize that the risk side of things. We looked now at psychology. Let's switch over to risk. Psychology is of paramount importance in regard to drawdown. But I think I've stressed it enough, so let's move over to risk. Small gains do not justify a large volatility. Remember, we're not only measuring our results, but how much risk we're taking to get it. It's always a relative return, not an absolute return. In fact, the drawdown is a very important factor, part of the equation for this measurement. When we look at absolute returns, it actually is meaningless, in my opinion. Of course, it says something. I mean, if someone made 60% last year, that's still a great result. But if he took so much risk that the drawdown was actually, I don't know, 60%, right? Is it still so good? If you would compare that to someone that made perhaps only 40%, but the drawdown was 20%. If you look at relative return, the second one is better because we have more return for less volatility. We have a 2-to-1 ratio in the bottom half and a 1-to-1 ratio in the top half. Every investor or trader would choose for the second one because of the lower volatility. Unless there's a specific reason why absolute return is the primary focus for you, there could be a situation, but normally speaking, if there's not any specific reason for that, it should always be 2 because of that relative return. So that's why drawdown is so important, because it says something about the volatility. It's that without looking at drawdown, we're only looking at reward. It's so important to look at reward and the risk. And preferably we have a 1-to-1 relationship. If you are making 10%, but you have a drawdown of 60%, I mean, it's not. I mean, still, of course, it's better than losing money, but it's obviously not the ideal state you want to be at. Let's see, amount of risk capital and tolerance of risk. All right, first of all, accept a risk capital that is really a risk capital and that you're okay with losing. Basically, I want to explain that once you've accepted a risk capital as really risk capital, then you will not see trading as that risky anymore. Of course, we have to realize trading is risky. I mean, I'm not trying to say that trading isn't risky. Trading is always risky. But if it's a capital that you are okay with risking, the risk becomes more tolerable. That's my point. And if we accept a risk that is connected with the risky business of trading, then we are more free to make good trading decisions that are not weighed down by our emotional insecurity and emotional baggage. In that way, some might even say that risk is good because it allows us to make profits. Let's go into a world where risk is not allowed. Well, we wouldn't be trading and we wouldn't be able to make any potential profit. So, although many traders indeed justly say that risk is dangerous, and it is, risk also has a good quality, otherwise we wouldn't be here, right? And we wouldn't be trading. So in that regard, risk is good. But it's only good if we can accept the consequences of the riskiness, if you see what I mean. So once again, yes, risk is something we must be aware of and must be cautious of. But when we accept it, it liberates us to be able to focus on our trading more than being too concerned about risk. Once we've accepted a level of risk that we are okay with, we can, of course, have to then still manage that capital via risk management. Just because we're okay with accepting a certain risk, let's say we're okay with losing 10K in dollars as a trading capital, doesn't mean that we squander that. No. But we're okay with, we feel comfortable with accepting that risk. Then the next step is that we have to rigorously still manage that risk. That never changes. We manage that risk. We take 1% risks or 2% risks or anything preferably below 3%. But because we're okay with that risk and we rigorously manage that risk, then we are in a good situation. Because when we lose 1, 2, 3%, little amounts of something that we already find acceptable. So there's no need to panic. And of course that risk management is something that depends. I mean, if you feel comfortable with lower drawdowns, you would probably choose 1% or even 0.5%. And we need a consistent implementation of risk management so we never make a costly mistake or blunder. We want to, at all costs, make sure we don't make any of those mistakes. It could be a very psychologically damaging as well for the risk management. Let's say by accident we took a 10% risk instead of 1%. Somehow we hit the zero too much. That's devastating, right? We have to make sure that this is by all means we triple check our entry orders and basic things so that we never get into that position. Because it's all about two capitals. It's about risk management, risk capital, or risk management, and also the psychological management. Or it's about risk capital and psychological capital. We have to make sure that both are intact. If we lose our psychological capital, we would be too unfocused to really be effective. Alrighty. Now the choice of risk levels and risk management. Although I said, you want to think about how much you target as a goal, and then I'd have an idea what your drawdown should be. I would not recommend actually to start that way. Actually, I would ask yourself, what do you feel comfortable with losing? What do you feel comfortable with? Do you feel comfortable with losing 20%? Then fine, go with 20% as a drawdown. That's what you should expect. Do you feel comfortable with 40%? Okay, go with that. I mean, if you feel comfortable with 80%, I guess you can do that, but you might want to think twice about it, though. I mean, if you really feel comfortable about it, there's of course two levels. There's one about thinking what you feel comfortable with, and second is actually feeling comfortable with the development when it's happening. You might think you can live through 80% drawdown, but what happens if you actually go through it? Then you might be shaken up and totally nervous about it. Beforehand, things look less tough than perhaps when we go through them. So be careful with that. Let's say you feel comfortable, reasonably comfortable with 30%. Well, then go for 25 or 20, right, at first, when you use this technique. Accept that then as your goal. Go for a 1-to-1, or depending on your experience, right? So flip it the other way around. First think about drawdown and then translate it to a goal. Then go to your strategy results and find out what the biggest drawdown was. What was your losing streak, all right? Now you might want to be a bit spacious with it. If you notice that you had a losing streak of 10 trades, I don't know, make it 20 so that you're spacious, you don't take it too precisely. Then, when you had a drawdown of 20% and you had a 20 losing streak, well, then you can take 1% risk per trade. Or if you have a losing streak of 30 and you have a drawdown of 20%, you can take about 0.6% risk per trade, roughly speaking. So you have an idea of what kind of risk you can take. What the idea is that, let's say you're risking 0.5% per trade, and that you can come across a drawdown. You could expect a drawdown where you have 20 trades. So you know that you could expect about 10% drawdown then. And say that you are willing to accept 20. Well, then you still have some leeway. You still have some space. You have twice as much actually space. It's always good to have a bit more space. You don't want to push it too precisely. It's anyhow just a rough calculation, of course. And then what you can do is look at the structure of your profit and losses to get some more data about your results. I mean, how reliant is your strategy on missing trade setups? Is it a complicated strategy where you can make a lot of mistakes and inaccuracies? The reason why you could ask these questions is because if you look at your result, your expected result, how much can you really expect it when you trade day to day? Is it very reliant? I mean, if you miss a strategies, then are all the results then screwed up? Yeah, I mean, if you make a mistake, does it all go through the window? And you can also analyze your losses. I don't know if anyone has heard of the 80-20 principle. I want to actually suggest to have a webinar on that principle next month. Is anyone interested in it by any chance? It's basically the principle where 80% of outcome come from 20% of inputs. In trading, we could say 80% of winners from 20% of the winners winning trades, 80% of the losses from the 20% of the losses losing trades. It will be interesting to see what those losing trades are so you can evaluate it a bit better. Last but not least, before I hand it over to Nennet, there's a way to have a measurement if your strategy is lucky or not. It's called the T statistic. It basically takes the expectancy per trade, divides it by the standard deviation, which is volatility and risk, or another way of measuring risk, by the way, and multiplies it by the square root of number of trades. What is the square root of number of trades? Is basically the more trades you've had, the more reliable that number becomes, which is logical because if you have a high number of trades, the number, of course, becomes more reliable. If you've taken 1,000 trades, then you've had a lot of experience with that strategy. If you've had 10 trades, of course, you just started out, and that number doesn't mean that much. So that's why when you multiply it by the square root of number of trades, it kind of gives more weight to the more trades you've taken. What does the first part of the equation say? It basically says, okay, what do you expect per trade, and divides it by the risk. So if I expect 1% profit per trade, and I divide it by the risk, then you have kind of what I already told you about the risk versus volatility, I mean the reward versus volatility and risk kind of equation. If you have a level that is above 2, your strategy is not lucky. You have a consistent, long-term, profitable strategy. All right? Now, if it's below 0, it's probably going to be more lucky. You know, that of course, that number can vary. It can go up and down, so it's never really a hard conclusion, but you might want to be at least a bit cautious with it and double check some things. Let me say it this way, right? Of course, the more trades you have and the longer it stays below 1, then obviously it doesn't look too good, right? Alrighty, that's it from my side. I'm going to hand it over now to Tarantula.
Thank you, Chris. Thank you a lot. You covered pretty much about drawdown, so I needed to reduce my PowerPoint presentation. So, guys, now I will continue, and first I will give you a brief snapshot of drawdown. Then I will move to other things, which, of course, Chris didn't cover, because if he covered that, I wouldn't have anything to talk about. So, great part from you, Chris. Really very useful information. You know that I really pay a lot of attention to drawdown, and generally, because I am a full-time trader, I really know a lot about drawdown and all those things. And what Chris said is absolutely true. If you're aiming, guys, for 100% per year, you need to be ready to lose everything, and that is normal. And many so-called traders, which you can see over the internet, basically, I don't know, showing their accounts and bragging about their statistics, are just simple expert advisors who are doing so-called arbitrage trading and high frequency trading, so-called HFT. and to many brokers those kind of deals are forbidden, and the money they get are not from real trading. So basically they are using either high frequency trading, arbitrage, or probably, which is also very common, so-called martingale. And you know what I think about it. It's definitely not trading in its own sense. The trading is what we do, what we analyze, what we trade, manual trading, no robots and stuff. And because robots do not have psychology on its own, and they're simply following their the rule set and the equations which you have built in the robot. So that is not a case for this webinar. We will talk about normal drawdown, about drawdown which can happen to traders who are really trading by themselves, and we want to talk about arbitrage, high frequency trading, martingale, robots, because for us they do not constitute the real trading examples. Okay, so drawdown is the difference between the balance of your account and the net balance of your account. So that is the primary definition of a drawdown. So the difference between the balance and the net balance. When we talk about standard definitions and very simplistic definition, I can say definitely it's a reduction of someone's capital. So that is maybe the simplest and the best definition of drawdown. It's a reduction of someone's capital. We measure the drawdown in so-called peak to true dip. Okay, it's peak to true dip. Its dip means decline in percentage. So take a look at the lower graph. You can see this account was at its peak on 10,000, let's say, dollars, and true was basically around $5,000. So the dip, decline in percentage between the peak and true is called drawdown. And if the account, let's say, was I don't know, let's say 100,000 and you lose 50,000, it's 50% of drawdown. In this example, we can see $10,000 to $5,000, so it's the same. It's 50% of drawdown. So what is the difference between trading $100,000 account and $50,000 account or $10,000 account? So basically, in between those, trading $100 account is definitely, if you experience 50% drawdown, it's bad for your psychology. It's the same. $1,000 account, 50% drawdown is only $500 loss. So, you know, $500, it's manageable. It's not big money. But if you lose $50,000, and it's still the same, 50%, because percent is always the same. It's percent. But the money is bigger, right? So the effect on your psychology will be much bigger than if you were, I don't know, losing $500 on account. So it's not the same. And you know, when psychology goes wrong, then you go into so-called infamous spiral of doom. Then you need to cope with your ego, with your revenge, with your inner self, and that is the huge problem to many traders, because suffering a let's say $50,000 account drawdown, it's not the same as $500. So the effect on your psychology is you will be definitely using more and more, I can say, leverage or volume traded in order to compensate for that loss. And that is bad. That is definitely bad. And I know many traders who admit that they lost 50% of the account, and even 70% of the account, and the only thing they can think of is to fund their account and start all over again. So what Chris said, I'm 100% with him. If you're aiming for 20% per year, then be ready to have a drawdown of 20% at least. If you want to make 100%, then it's the simple truth. Be ready to lose all of your account, okay? And it's okay. If you're willing to lose your account, well, maybe it's you know, you like to risk. You like to risk a lot. It's okay if you have the money to start all over again. But the main principle, what I've been teaching and Chris been teaching all these years is stay in the flow, stay in the game as long as you can. Why would you fund your account with money if you can spend that money on other things? Okay? So always pay close attention to the possible drawdown, to the things basically which you want to do with your account, and never allow yourself to become deeply involved with your inner self, because that will definitely mean that you're sucked into a spiral of doom, and it's very hard to find an exit and went up through that spiral again. And what you can do is then, well, if that happened, do not lose everything, just fund your account and start all over. But you need to find the remedy. I will also mention what kind of remedies we take in order to trade properly with the normal drawdown. Net balance also takes into account open trades and trades that are currently in profit or in a loss. If your account net balance is lower than your account balance, it's also called drawdown. So now this is very simple. You know what the drawdown is, so we can move on. The thing is, it will always exist. Okay, it will always exist, and there is a 0% possibility for someone's account to have zero drawdown. That is absolutely impossible. So some form of drawdown will always exist. And guys, do not be afraid to lose 2, 3, 5, 10, 20% of your account. Everyone in their life has lost 20% of trading balance. It happens. You just cannot know what can. I know many traders were long on 1.2000 on euro dollar, and they were holding their positions over the weekend, and what happened? Euro dollar dropped 150 pips. Now imagine when you wake up, or I don't know, you don't need to wake up, you just open your platform and you see that your account is in a huge drawdown. You didn't know it will happen, but it happened once in a lifetime. I don't know, it won't happen once in a lifetime, it will happen many times. So that is why I'm saying it will always exist. It's the normal part of trading. So do not be afraid to lose 2, 3, 5%. Every single trader on this world will lose that kind of money. He or she will suffer from a drawdown. But just do not be afraid of it. I know that some traders are definitely scared when they lose 5%, 10%. Well, if you risk 2% per trade, it's only 5 losing trades in a row, and you're 10% in a drawdown, in a loss. So, you know, it's not hard to cover, but be ready for that. If you're not ready for suffering drawdown, then trading is not for you. You should do other things. You shouldn't trade, because it will affect your psychology, it will affect your understanding of the market. It's not about the system, it's not about the market, it's about yourself. As soon as you admit that drawdown will exist, the sooner you will be better, and you will be definitely ready to trade. Without the proper understanding of drawdown and admitting it will happen, don't trade. Simple as that. I call it personally retracement in the balance chart. So if your balance chart looks like this, something is not normal, right? Because you just make money and you don't lose anything. It's not normal, definitely. These things are not normal because either you're very lucky or you're risking a lot. or you're using high frequency trading robot, you may be banned from trading, maybe you won't be paid out because brokers have their legitimate right to basically stop you from withdrawing the money if you used arbitrage. And that is okay. Arbitrage is not, it's not good. It's forbidden. Okay? So this is not normal. But this kind of the account, this is okay. This is retracement. Every single chart we trade has a retracement. Why wouldn't your account has a little bit of retracement? It's not bad. It's perfectly normal. You just need to know how to cope with that. So I call it retracement in the balance chart. Now, current drawdown, historic drawdown, also known as maximum drawdown, those are terms we constantly, basically, we constantly are facing. So current drawdown is a drawdown which you are currently suffering from, okay? Historic drawdown is important. Some call it maximum drawdown. So that is the amount of equity lost by a trader during its entire history. So let's say a trader may have recently experienced 30% drawdown, but in the past he could have experienced a much more significant drawdown, let's say 60-70%. The biggest historic drawdown is referred to as the maximum drawdown. Okay? Now, why is that important? Why that historic drawdown is important? Why is it important that someone has lost 70% in the past and now it's only 20%? It's important because it helps to determine investment risk. So if you plan to give money to someone to manage the money or something, you should always check the history to see how big the drawdown was and historical drawdown. Funds or traders which have gone through periods of significant drawdown are seen to be, let's say, significantly more risky. Okay? Now, the thing is, a limited historic drawdown suggests that a trader has been effectively managing risk. That is why I always remind you about risk management. Out maybe of all things which are important in Forex, good system, I know, good trading method, knowledge about Forex market, risk management is also important, but maybe a little bit more important than all of that. Risking only a limited amount of their total equity is the way to go. Okay? So historic drawdown is very important if you want to invest money in someone or in something or give money to someone to trade your account. That is why you should always check historic drawdown. Let's say last year, it's okay. Yearly drawdown or last 6 months, not current drawdown. Now, this also has limitations versus future risk. So while drawdown can be useful in determining risk, it definitely has some limitations. Historic drawdown provides no indication of future risk. As always, it's the same in Forex market. Past results do not represent the indication of future results. It's simply a measure of past performance. Now, while a trader may have a very low historic drawdown, you don't have any guarantee that the trader won't blow their entire account the next day. Simply, there is no guarantee. Drawdown has a limited use when you try to evaluate the risk. But it can give you some data of the riskiness of an investment proposition. Okay? So you, being a trader, must realize that there is no guarantee that past performance will affect future performance. But you can get a cue of someone's trading style by watching his risk management and historic drawdown. So in this example, we can see that, look at this, for example, account. This account was good, pretty much successful, and it went, let's say, it is successful. Look at this, because this is how we call it, uptrend. This is balance sheet uptrend. You can make a trend line here, right? Or you can make a channel. Everything is the same as with trading. You can make everything with this. But look at this. It started with $50,000, okay, and then it dropped to, let's say, 25. So maximum drawdown was 50%. The account lost half its value from this point to this point. But suddenly, look at this. It went to 100,000. So it was doubled, basically. Now the current drawdown is 20%. This is current drawdown. This is historical drawdown. Now it's up to you, basically. It's up to you how to, whether you will, I don't know, give your money to the trader to trade for you or not. What I suggest, guys, is always be traders. Trading is an interesting job. You can give a part of your money for management, but always keep the money for yourself, for your trading, because if you want to be a trader, then you need to know how to trade, and that is where we are helping you. So I'm talking to you as a trader to a trader. Okay? Do not just give the money to others to manage you. Invest in yourself. Invest in your knowledge. Buy a good trading system. Buy a good trading method. Follow our analysis, mine and Chris, and I know read a lot. That is also investing in yourself. And we will help you. We're helping you to become better traders. So if you see this kind of drawdown on someone's account, you will always refer to maximum drawdown. But it's up to you, because in current terms, this account is very, very profitable, whether you will invest in that kind of trading strategy. Now we have the term so-called it's famous in Forex, and you should know about it. It's called profit to drawdown ratio. For example, a performance that shows 30% profit after a 30% drawdown, it's much better than a performance that reaches 40% profit after 80% drawdown, or 50% of profit after 80% of drawdown. So it's called profit to drawdown ratio. Okay? As Chris said, 20%, if you want to earn 20% per year, then be ready to risk and suffer from a 20% drawdown. If you want more, then, guys, it's very good. Chris mentioned that, because that is the ultimate truth in Forex market. If someone tells you he can make you 100% per year, be definitely sure he will be risking 100% of your account. It's you know, 30% risk and 100% gain. It's sooner or later the account will suffer from some form of drawdown. Maybe some positions which are open are in drawdown. They're still not closed, but they're suffering a drawdown. That is still known as a drawdown. So be ready for that. Losing streak also, because basically we want to have an edge, and that is why we want to find a good system. Trading method or system that is 70% profitable, it's a good, I can say, arsenal, and pretty much a good edge to have. But because your system, let's say, is 70% profitable, does it mean that every 100 trades you make, you will win 7 out of every 10? So how do you know which 70 out of those 100 trades will be winners? You don't know. You could maybe lose first 30 trades in a row and win remaining 70. That would give you still the 70% of profitability. But you need to ask yourself, would you still be in the game if you lost 30 trades in a row? Now we come to the ultimate truth in Forex market. Risk management with a good and proven method is the ultimate way to go.
no matter what system you use, you will always have a losing streak. If you have good money management, you will not lose much. That is why I always suggest, guys, risk 0.5% per trade. Because if you go 5 losers in a row, you would only lose 2.5%. If you risk 2% per trade, you would lose 10% in 5 losing streaks. 5 losing streak, 5 losing trades in a row. Okay? There are always macro and microeconomical risks. Look what happened to dollar yen. Look what happened to euro dollar. Look what happened to pound dollar. How would you know that tomorrow is NFP? What can happen? We will see what can happen. But would you like really to carry over the trade over the weekend? You know, 0.2000 on euro dollar was definitely excellent level to go long. Excellent level. 10-year low, guys. The last 10 years, euro dollar never, last 4 years, euro dollar was above 1.2000. And in a single night, it dropped to 1.85. And what is that telling you? You just use a low risk. Always, always, and always. If you can make money on $100 account, if you can make 5%, then you're ready to sell your car or, I don't know, house and invest $50,000. Because if you can make 5% on $100, you will still be making 5%, but on bigger account, with very low risk. That is why my goal is not to make 20% per month. My goal is to make 2 to 5 or 2 to 10% per month. And I'm happy with 3% in average. Because I don't risk much. Now obviously, if we suffer from 20-30% drawdown, we need to, sometimes it's you know, if you don't want to fund your account, but you want to recover from a loss, then maybe it's okay to use 1% of a risk instead of 0%. But it's still low risk. It's not 5% per trade. Retail gaps are dangerous. Again, reminding you on euro-dollar gaps. So retail gaps can give a significant drawdown in a single night or a day. And risk management is most important. This is the table. I will be quick. We are already over the time. So if your account size is $10,000 and you risk, let's say, 3% of maximum risk, or let's say for scalping, 10 pips stop loss is $100. So you can make 3 trades maximum. The optimum number is that you can make 6 trades because you use 0.5 lot. On account size of the same currency, $10,000 and 3% of a risk, if you use 0.3 lot and you have 50% of stop loss and your risk is 3% maximum, you can have 2 trades in a loss of 50 pips. It's not going to happen so often if you have a good system. But I know many traders who are trading $10,000 constantly one lot account, on one lot on $10,000 account. And if they lose 50 pips, they will lose 5%, $500. It doesn't fit in 3% of a risk. So how to handle drawdowns? Change something, guys. Change something. Okay? You should definitely assess yourself and see if there is the time to change something. Reduce your lot size. Assess your psychology. Avoid typical new mistake. What is typical new mistake? I buy new system, win a few trades, everything is working as it should, I'm happy and dream about quitting my day job and retire. Then all my gains are wiped out in a single day. The equity goes down. Wow, it's panic time. This system is not good at all. Ooh, well, you start to swear. Let's drop it and stay aside for a while until I find new system. In the meantime, there are plenty profitable systems. So what was on my mind when I choose this crappy system? But yes, good. I bought a new system. I will recover everything. Now the new system is installed. Great. Ooh, this is the best system. Everything. Oh, wow, I love Forex. Excellent. Now what do I see here? I just woke up. Wow. All my profit is gone. I got a margin call. Nothing is left on my account. Maybe the first system is not so bad. No, wait, I shouldn't left my first system. Now I will fund my account and start again with the first system. Now again the first system is good. I have 10 trades in a winning streak. I didn't lose anything. I will put more and more trades. I will use more lot size. Great, this is everything in my life. Well, I made all my profits. I recovered all previous losses. Now what happened? Wow, one single bad day, micro or macroeconomical new or retail gap or something your system wasn't prepared. It's human factor, and your all profits are gone. Okay? So guys, Forex is not a scam. You yourself are scammed if you think it's only about the system. You must perform a very deep analysis of your system, and you must know how to handle signals with the system. What is the system telling you? Should you trade with 2-3% of a risk or 0.3% of risk? You need to know the maximum historical drawdown. You should expect at least, I don't know, 20% of drawdown. It's okay. So do not basically raise your lot size even for a successful system. Do not reduce the risk if it's already reduced. Just let that system do the job for you. Okay? So that is, you should always demo trade the system before you start. And accept your losses. Be willing to accept that you will lose even in the best method. Do not trade with what you cannot afford to lose. Okay? And if you are making money with the system, and you know because you're demo trading it, stick with it. So guys, this is what I have prepared for you. I have a question here. Okay, let's see questions. Dino is asking, I tried on a lot of forums to find an answer, but I'm interested how to calculate a distance and transpose number of pips. Okay, I cannot open your link now. We are on another part of webinar, but please send me your question to my email, tarantulafx@gmail.com, and I will answer you. Okay. So thank you guys for listening to this, and as always, follow us, follow Admiral Markets, our analysis, live webinars. We are here to help you. Tomorrow is NFP. Expect new NFP analysis tomorrow. And be ready to trade at least 3 hours before NFP. It should be okay. Do not risk during an NFP. So I wish you to trade safe, and we will talk to you soon. So cheers and trade safe.